Let's talk about how I don't know what you want to call them, richer, upper class, and some of the higher middle class people got a significant tax increase because of the new tax law. So, have you guys ever heard of itemized deductions? All right. In this, if your itemized deductions exceed your standard deduction, it would be in your benefit to itemize your deductions. And what are itemized deductions? This is where you can write off things like your mortgage interest, medical expenses, charitable contributions, property taxes, any income taxes that you pay into the state or locality, you can write those off as well. And then there's some miscellaneous stuff, which we won't get into. But those are the main things: mortgage interest, property taxes, medical expenses, and charitable contributions. So we'll just focus there. The big change that happened with the TCJA was they limited the amount of taxes that an individual can write off, and they capped it at $10,000. And now you're thinking, holy crap, $10,000, who's going to even be able to write that off? Hear me out. So picture your high-level executive in the state of New York or California, or we'll do, New York City, right? Where the local tax rate's like 10, 12%. Property taxes are ridiculous because of how high the property values are. And everything, it's just all relative, but the prices are inflated. So you've got your high-level executive in New York City who's making 300 grand a year. He's paying, like I said, 10% to the city of New York. He's paying, whatever percent to the state of New York. So right there, he's paying thousands of dollars just in income taxes. So now what are his property taxes? You get the picture, right? So in 2017, that person gets to write off $20,000 in taxes on their itemized deduction sheet. All of a sudden, it gets capped at $10,000. Doesn't matter. You spend $20,000, $30,000, $40,000 in taxes, property taxes, car registration, income taxes to state and localities. You were spending, $20,000, $30,000, $40,000 on that stuff, but now it's capped at 10. So let's say the person is, they're, like I said, high-level executive in the city of New York making 300 grand, 400 grand a year. Let's say that they were paying 30 grand in taxes, okay? And they could used to, in 2017 and years before that, they could write that off on their federal income taxes. So it was $30,000 write-off, and now it's capped at 10. So you're paying federal income tax on that $20,000. And when you're at that income level, you're in the top income tax bracket, which is, I think it was like, 35, 39%, somewhere in between there. So now that $20,000 on, we'll say 39% is like, you're paying an extra $7,800 in federal income taxes. Wow. Ouch, right? So that is also another example of how just because you see a tax rate cut, there can also be changes made to the tax base in which can raise your taxes and then outweigh the income tax rate cut. So that was an example of how the higher level earners have experienced a tax increase because they can no longer write off the full weight of all of the taxes that they paid: property taxes, car registrations, city and state income taxes. So that's kind of where the tax rate and tax base are important, and understanding both of them are important because you used to be able to write off this, or you used to be able to write off this much. Now they changed it and you can only write off this much. You're like, there's a tax rate cut. Why in the damn hell is, why did my taxes go up? Take a look at how they're figuring your tax base now. Tax law changes all the time, all the time, every year, right? So that is how the new tax act has also raised taxes on the, we'll say, the upper class. Okay, they used to be able to write off all of their taxes full weight. Now it's capped at 10 grand.